Hello folks, welcome to Pro Trader Strategies Market Commentary for Thursday, March the 18th. I'm Eric Wilkinson, and you very well may recognize me from mainstream media, where I've talked about the economic data, the geopolitical environment, how that impacts the markets with some of my market analysis. And I do the same thing in these daily market commentaries, but I go a little bit further and talk about these option strategies I'm implementing into my portfolio on any given daily basis. For you folks, what I'm doing is using these real life examples to show you folks how we trade options here at Pro Trader Strategies. I also really dig into these details in my webinars, so please go and check those out because we streamline the process for you folks to find those strategies. Bullish assumption, we aren't just buying calls. We are looking at what's going on around this underlying, and based on our directional assumption, find the optimal option strategy for that directional move. All right, so without further ado, let's get on with economic data. Across the pond, Great Britain, we got the bank rate changed. Nothing to see there. Lagarde spoke all night, who is the ECB president. So really nothing going on across the pond other than talking heads for the most part and same old, same old. Here in the United States, though, we got the Philly Fed manufacturing number. That came in at 51.8. Expected to be 22.5, so just crushing it. As a matter of fact, that's the highest level we've seen since, I don't even know, back to maybe 2005 or something like that. I mean, it is a massive number that I can't even go back on my charts to find a number higher than that at the Philly Fed manufacturing number. So that is just knocking it out of the park, especially when we've been seeing some of these manufacturing numbers maybe showing some kinks in the armor. This obviously is not. I mean, like I just said, I can't see a higher reading for the Philly Fed manufacturing back before 2005. So just an awesome number. Unemployment claims coming in at 770,000. That's the weekly unemployment claims, expected to be 704,000. So a lot more than expected there. That is not obviously a good thing. And then the ADP non-farm employment change, 100,000 negative 100,000. So that is more layoffs than hires there. Natural gas storage is coming in at 11 billion cubic feet drawdown, expected to be 21 billion cubic feet drawdown, so less than expected on that front. Also, we have Powell speaking. That was a bit of a surprise to the overall markets, but just some closing statements there. Yesterday, during his speech, really talked about, hey, we're not going to raise interest rates until probably 2023, and we will signal well ahead of time so the stock market isn't caught off guard when we start raising interest rates. That whole being very transparent. That kind of started back in the 90s with Greenspan. As a matter of fact, when we were at the Fed, there was guys that would be off the floor moving, and they would move interest rates even off time. You know, now it's basically coming out at around 2:15 Eastern time when they release those statements. That is a finite time to keep an eye on, and that was actually part of us in the Fed Fund Futures, where we talked to Greenspan and said, hey, you know, there's people legging spreads, putting on hedges, and when you come in and just blow it out and say, hey, we're changing interest rates off meeting, that affects massive amounts of money. Each one lot in the Fed funds was a $5 million contract. So we're talking about notional value of thousands of contracts being traded when the market is moving off meeting. And those people used to have to make phone calls, take off trades, put on some hedges, all kinds of crazy stuff was happening. Now they actually release it like it is a data point and are being much more transparent going forward. Anyway, with that being said, we've got crude oil finally coming off, down by almost $3 right now. Now, something to be said, we've continued to see these higher highs, higher lows. That is indicative of a bullish market here. Now, we still have not broken that pattern. We're going to have to get down below 59. I would say safe bet would be calling it a 58 handle. That would signal that we have broken that pattern of higher highs, higher lows, because then we would have created a lower low. So that would be more indicative of a rollover here. We are down $3, but we need to be looking really for that 58 handle. I'm not even talking to 50 into the 50s. I'm saying 58, folks. All right, that's where we're going to be breaking that pattern there. All right, gold futures right there at the point of control. Note what has happened. We have seen this point of control for the volume shift lower. That is usually a signal that, hey, we are accepting prices down here at these levels. That 1800 handle, the 1900 handle even, is probably well out of the works for at least the near time. But with that paradigm shift, we are right down to a point of control, moving that where volume is being accepted at lower levels there. Bonds are off another point after Powell yesterday gave them a little bit of a boost, talking about, hey, we're not raising interest rate today. Bonds, 10-year, kind of kicking the Fed in the face right now, saying, hey, you know what? We don't really trust you guys know what you're doing, which is probably what a lot of people outside of the Fed are wondering a lot of times. But having said that, they're talking about they are not going to, if you just see a blip of GDP or a blip of inflation, that is not going to be something to get them to jump on raising interest rates. It's going to have to be something that is a little bit longer term before they start really considering that. So bonds kind of falling on, down over a point there, despite the fact that the Fed said they're not going to raise interest rates. Now, equities. We got a mixed bag here. We got the Dow Jones, again, moving to the upside. This is led by a lot of banks. I mean, if we take a look at banks, they are going parabolic. Things like even Caterpillar are making all-time new highs. The banks, folks, or not the banks. Banks are doing very well. But what I meant, the airlines, we talked about that. I took off my UAL probably a little bit early because I was looking at all these topping patterns and seeing that these airlines are near at least areas of 2019. Now, those guys were doing very well. And remember, all last year, they were at 20% capacity, folks. They might be at 40% of capacity at this point, and we are trading at price levels that was done before the pandemic. And there was a lot of travel going on. There were people spending money and traveling and flying and more time, the lowest unemployment we had seen in history, basically. So people were spending, the economy was doing very well. I don't think that the airlines are anywhere near that type of environment. I don't know that there's a lot of people that are really ready to jump back into an airplane right now. Anyway, and here we go with the tech sector, again, kind of falling off. We got the bank strength. We've got airline strength. Tech sector outside of the FANGs are struggling a little bit. We've already seen that correction in the Apple trade. Remember, I started selling some puts to cash secured puts in order to get long that with this bit of a correction. I think that there's value. It's almost a point, one of the first times really, where we can say Apple is kind of a value stock. All right, well, we got, like I said, NASDAQ off. Even the S&Ps pretty close to unchanged. Sloppy topping pattern. Yesterday was looking a little bit better, but today not really any kind of confirmation. And you can see that's because we have an inside day. And true to form with the value area high and low inside of yesterday's range, we have an inside day, pretty quiet. But that hasn't stopped me from trading. Well, with Home Depot, yesterday looking like a bit of a topping here, and I was talking about it looked like it was time to get out of here. Anytime we get up near this area, I wanted to get out at around 285. We can see that we did come very close to that, but I decided to, actually we did clip that today. But I got out of this yesterday ahead of that. And if we were to talk about what I've done with this trade, this started out as a poor man's covered call trade, folks. And with that said, I've lowered my overall cost basis on this quite a bit. And I originally started this out with the March, January, buying the 210 calls in the March and selling the January 285 calls. So that was back here in December, right around here, this area here. So this is actually the day when we got it in on this bottom here and looking for a bit of a move to the upside. Stimulus checks, I was a little bit early on this. I thought that these types of companies would do very well in that type of environment. But with that said, I ended up getting into this trade right around where the underlying was trading. And if we add in the 210 calls, right, plus the debit I paid, which was 54.67, my break even is right there at 264.67. So that's basically where I'm. 264.67 is where I'm basically synthetically long with this stock by doing the poor man's covered call, buying the in the money calls at 210, selling an out of the money call at 285. That out of the money call pays for the extrinsic value of my in the money option. So that puts my calls at value, face value, where I own just the benefit of that stock being where the strike is to where the underlying is trading. There is no extrinsic value. It's all intrinsic value. And then I ended up rolling those Jan 285 calls out to the February 295 calls right here in January of, I'm going to have to try and draw a line here. January, it's probably right in here. So rolling out those calls for a $1.81 credit, rolling the Jan 285 to the February 295s. That was that $1.81 credit. And then I rolled them again to the Feb, from the Feb to the March, and collected another $2. All right, so lowered my overall cost basis on this trade, or look at it like you're collecting a dividend on a stock that you don't actually own. It's a synthetic long stock. And then I rolled those I rolled the Feb to the March for that $2, the March to the April. Now when I go from that March to the April, I'm long a nearer duration option and short a further duration option. So it's not necessarily still that covered call strategy, but what I'm trying to do here is just lower my overall cost basis during the time that I still own this option, right? If my short calls were breached on those April, I still am long those March calls that are near duration that I could offset them if I had to. So I wasn't too concerned about that at that point in time, to keep that in mind. And collected another $1.94 on that. So all in all, I actually ended up buying those April back for $1.13. So let's get that $1.13 where I got out of it. But here we've got this 2, 4, 5, let's call it 575, right, is where I lowered my overall cost basis on this trade, minus that 113, so $4.62, all right, for every one lot that I own, or every one lot I am long in the 210 calls. So, like I said, my original buy-in break-even was 264.67. Well, you can see I dropped it by $4.62. So, let's just round it off and call it $260 or $260 is really where I'm looking at for this trade. Well, with that said, I got out of these at 72.60. All right. So when we talk about that with my strike location, really what I've done is lowered my overall cost basis on the original paid. Remember, these are the 210 calls, right? And I talked about my break even being there. Well, that said, 54, we can do it also 54.67 a different way, and plus the $4, or subtract out the 462, right? Now we've got $50.05, right? Well, then I get out at 72.60. That's a total profit of 22.60 on this trade. All right. So that was a very nice win on that, lowering overall cost basis, increased that spread over time, and made a nice little profit on this little poor man's covered call trade. Now, we've been talking about covered calls with the pen, IBM. This was a great one for people that are struggling with margin in their account or don't have big account values but want to trade some of these stocks. Using options is a great way to avoid some of those pitfalls, and I showed you that with that one. All right, so LUV, I talked about this. These airline stocks I think are just overdone. I did play UAL to the upside. That was based on a chart pattern. Did well on that, but now I think that these are getting a little bit frothy here. And if I even take this from a daily chart to, let's say, a 5-year weekly chart, we can see that this is creating a nice little topping pattern here that would be hard to get rid of. And that is a quintessential topping pattern. We haven't gotten the confirmation. You folks know I'm usually a little bit early, and I'm not going to wait for a confirmation on this. I think this is ridiculous that we are at levels higher than what we were seeing pre-pandemic there. That's kind of ridiculous, folks. I mean, look at this. 5-year high is $66.99. We're $5 away from that right now. Come on now. So I decided to go in there and did this really small, though, in both my IRA and in my trading account. I basically did 2 different prices. I got my IRA a little bit worse than my trading account. But anyway, I ended up getting in here, buying these calls for IBM, or sorry, not IBM, for LUV, and I bought the June 60 puts in there for $4.40 in my trading account. In my IRA, I bought the June 60 puts in there for $4.30. Got it in my trading account and decided to put it over there in my IRA, and by that time it was a much better price that I could get. And as a matter of fact, it's even better than either one of those at this point in time, but not enough to really jump on board. I'm going to play this to the downside on a swing trade here. I think that we're going to at least have some type of correction. Look, those 60 puts are very tight to the market. It's about a 40 delta on that. I went a little bit tighter on it because I didn't really want to do the half strikes in this June contract. I don't love doing the half strikes. So I did it around a 40 delta, which is about an 80% probability of touch. I'm going to wait for this to maybe even come down to the point of control. This isn't going to be one of those where my put is touched. I'm going to get out of it. This is more of a trade for a correction. And I think we'll probably look to come back down to this point of control maybe in the next week or so. So that's the only thing I've added. Took off that Home Depot trade. I am looking at trying to take off a couple of other things, covered calls in pen and stuff like that. So still got some working orders, but nothing has got picked off at this point in time. And that's about all I got for you folks, other than I hope you guys have a great weekend, because I'm not going to be here tomorrow, folks, because I have my kids are on spring break and they want to go do something. So we're going to go up to Flagstaff and do some snowboarding. All right. All right. So that's all I got for you, other than take a moment at the end of this video to go over our disclaimers. We are not trying to get you guys to do these trades like in LUV. What I'm trying to do is show you guys real life examples of how we go through this on a daily basis in trading these options. I am not cherry picking anything, showing you how you would do it after it's done. I'm showing the process as we go through it. All right. So that's all I got. If you can't take that, take it easy.